Welcome to the 16th lecture of Unit 2 in the Ethan Trades Mentorship. In this lecture, I will be introducing what inversion PD arrays are, how they operate within a market maker model, and how to apply it to the charts. Inversion PD arrays are when a previously respected PD array from the opposing side of the curve is inverted, or in simpler terms, price closes beyond the area of interest, showing that price is not respecting it. For example, if you were trading the buy side of the curve, then you'd be paying attention to the bearish PD arrays from the sell side of the curve, and once those invert, then you look for those areas to act as bullish PD arrays. Vice versa, if you were trading the sell side of the curve, then you'd be paying attention to the bullish PD arrays from the buy side of the curve, and once those invert, then you would look for those areas to act as bearish PD arrays. The type of inversions that we covered in this lecture are inversion order blocks, inversion inefficiencies, and inversion balance price ranges. The listed inversions on this slide are the main ones I personally use, but if you take any PD array, you can use it as an inversion. I just personally think these ones I've listed out are the cleanest. Personally, the most used inversion PD array would be the inversion fair value gap. So make sure if you decide to use any inversion, use the inversion fair value gap. Anything else is extra knowledge that is absolutely not required. And I'm just trying to teach everything I refer to because that's the whole reason you're in this mentorship, to read price the way I do. The first inversion I'll be talking about is the first variant of an inversion order block, breaker blocks. Breaker blocks can be viewed as both a regular PD array of its own when used as well, so it hits two birds with one stone. The method I will be teaching you in this slide of how to spot breaker blocks is universal to wherever you choose to use breaker blocks. Majority of the time, the simplest way to determine whether you have a breaker block or a mitigation block is that a breaker block is when a method 1 or method 2 order block is inverted, whereas a method 3 order block is a mitigation block. Breaker blocks are the higher probability variant of inversion order blocks, and the key to spotting the difference between a breaker block from a mitigation block is to make sure that there is market structure incorporated with the creation of it. And so for now, I will be showing a very mechanical way to spot breaker blocks, and this method consists of two things: a market structure pattern and identifying the breaker block itself within the market structure pattern. When looking for a bullish breaker block, we look for a market structure pattern of a low, high, lower low, and higher high. When looking for bearish breaker blocks, we look for a market structure pattern of a high, low, higher high, and lower low. With this market structure pattern, when looking for a bullish breaker, we look for the highest up close candle prior to the liquidity raid and has been displaced through. When looking for a bearish breaker block, we look for the lowest down close candle prior to the liquidity raid and has been displaced through. And so the liquidity raid just pretty much means prior to the swing point being taken out. So this prior low before the lower low, right? The highest up close candle within the swing point right here that gets displaced through will be your breaker block. Vice versa, the prior swing high that gets traded through, and you're paying attention to the lowest down close candle within this swing low, and so you're looking for that as your bearish breaker block. Personally, when seeking a high probability breaker block, I do not want to see price trade back below it. This including wicking below it. If price does trade back below it, then I count the breaker as invalid. Vice versa, if I'm seeking a high probability bearish breaker, then I don't want to see price wick back above it. Otherwise, that would be a low probability breaker to me. Here is a schematic of a breaker block when it's used as an inversion order block, whereas the previous slide was when it's used as its own PD array. And so this is the exact same PD array, but now we're just identifying it from the opposing side of the curve rather than on the same side of the curve. And so here you can see that we still have that market structure pattern of a low, a high, lower low, right? We're changing from the sell side of the curve to the buy side of the curve now. displace through this high right here. And so we're spotting the highest up close candle within this swing point that gets displaced through. That highest up close candle, you want to make sure it's been previously respected. And so on the south side of the curve, we can see that this order block was previously respected. I drew a little line here representing a wick. And so that's your change in state delivery. Once it trades below it, creating a lower low, it displaces above it and closes above this prior order block. That creates that inversion order block, also known as that breaker block, because we're incorporating market structure. And so that would be the activation. You look for higher prices from that. Vice versa, it's once again the market structure pattern, high, a low, you have a higher high, and then price displaces lower past this previous low. And so we're looking for that swing low, the lowest down close candle within that swing low as the bearish breaker block. And so one more thing is we want to pay attention that it's being respected from the buy side of the curve, right? And so we can see this line here that represents a wick, trades into the opening price of this order block, displaces higher. And so now we know this has been respected on the buy side of the curve. Now on the sell side of the curve, looking at that as a bearish breaker block. And once again, activated once we have a closure below that prior order block. And so here is the zoomed out picture of both breakers and mitigation blocks in a market maker model. In this example, we can see that the only difference that distinguishes breakers from mitigation blocks is simply the market structure pattern that occurs for a breaker block. When choosing a breaker or mitigation block, I rarely use them alone and always look for the ones with a fair value gap nested within them. And that's pretty much the only time I use these PD arrays. Once again, a key thing to pay attention to as well is whether the order block had previously been respected or not. And so on the sell side of the curve, in this example, I have drawn out a line delineating the change in state delivery for each order block. And so if you look carefully here, these dotted lines here, delineated out in time, change in state delivery respected. So I decided to use this as a mitigation block. Why is this a mitigation block and not a breaker block? Is because you don't have a swing low here, right? So you just have a high, a low, and then a higher high. You don't have a low, high, lower low, higher high. And so this specific up close candle is a method 3 candle as well. And so we look at that as mitigation block. What do we pair it with? We typically pair it with any bullish PD arrays on the buy side of the curve. And that's going to be any of your inversion PD arrays that you choose to use from the sell side of the curve or the opposing side of the curve. You want to pair it with a bullish PD array, in this case, on the buy side of the curve. Vice versa, if this was a market maker sell model, then you look for a bearish PD array paired with the prior bullish PD array. And so moving along, this one right here is the breaker block. And the reason this is a breaker block is because you have a low, a high, a lower low, and finally you displace through this high, right? Activating this breaker block once this candle closes above. And so I've annotated which candles I'm using and referring to here. And it's these 3 candles right here. And the reason I'm referring to these candles is because as delineated out in time with this dotted line, trades back into the open of this order block and trades lower, right? Another quick study here, you can also see there's a balanced price range here. There's also a fair value gap or a volume imbalance. And so once you understand all the PD arrays, you can suddenly start seeing why price decide to turn around over here and continue lower, because now you understand there was a lot of confluence here telling you that price was going to turn around here. Moving forward back to breaker blocks, this next swing point is also going to be another breaker block. And the reason is because you have a low, a high, and then all the way down here, lower low, and finally you have a higher high, which is activated when this up close candle closes above that. In this case, I wouldn't look at it as extremely high probability because we failed to displace above it, but technically using the mechanical method, this is an activation of this order of this breaker block. And so here, delineate in time with this dotted line, you can see that trades back into the order block opening price initially on the sell side of the curve and trades lower. And so we know that this method 1 order block has been respected. And last but not least, here you can see that this final breaker block is activated once we displace above it, close above it with this up close candle. And I forgot to draw a line here, but this opening price of these two up close candles is respected and price displaces lower from there. And so you'd be referring to both of these candles as the breaker block. The next type of inversion I will talk about are inversion inefficiencies, starting with the inversion fair value gap. Personally, fair value gaps are a personal favorite of mine, and this is because they are formed very often, and so I refer to them majority of the time as my go-to PD array. In my opinion, all you need to become profitable is inefficiencies, highs, and lows. But once again, I'm just teaching all of this so that you can learn how I read price. Just as any inversion PD array, an inversion fair value gap is created when a candle closes beyond it, invalidating it. And so, for example, on the left, if you have a bullish fair value gap, once price closes below it, then it becomes a bearish inversion fair value gap. Vice versa, on the right, if you have a bearish fair value gap, once price closes above it, then it becomes a bullish inversion fair value gap. The next type of inversion inefficiency is the inversion liquidity void. Once again, just as any inversion PD array, an inversion liquidity void is created when a candle closes beyond it, invalidating it. And so, for example, on the left, if you have a bullish liquidity void, once price closes below it, then it becomes a bearish inversion liquidity void. Vice versa, if you have a bearish liquidity void, once price closes above it, then it becomes a bullish inversion liquidity void. And so that's delineated on the right side here. Last but not least, the next type of inversion inefficiency is the inversion volume imbalance. Once again, just as any inversion PD array, an inversion volume imbalance is created when a candle closes beyond it, invalidating it. So for example, on the left, if you have a bullish volume imbalance, once price closes below it, then it becomes a bearish inversion volume imbalance. Vice versa, if you have a bearish volume imbalance on the right side, once price closes above it, then it will become a bullish inversion volume imbalance. One thing that you will most likely hear me call inversion inefficiencies is inversion gaps. And that's just me simplifying to save my own breath. So yeah, majority of the time, I will just say inversion gap for any of the inversion inefficiencies when I'm doing live videos or streams, just to kind of skip the technicalities. And so here is the zoomed out picture of all inversion inefficiencies in the same market maker model as earlier. Remember, the key to understanding which inversion has higher probability of being respected is paying attention to whether or not it has been respected on the opposing side of the curve. In this case, it would be the blue dots I've annotated from the sell side of the curve. And so a lot of the times here, the blue dots that I've annotated, these are what you're going to want to refer to. If the prior inefficiency or any prior PD array you want to invert, make sure it's being respected. And so in this case, all the blue dots, I actually forgot to add one right here, but all the blue dots are showing that these prior inefficiencies are being respected. And so once we're on the buy side of the curve, they are once again respected. Just like support and resistance, if you know any retail concepts, you don't have to learn it, and I urge you not to learn it, but if you do come from a background of retail concepts, then that's just, your true support and resistance levels. The last type of inversions I will talk about are inversion balanced price ranges, starting with the balanced price range itself. Personally, I don't prefer to use inversion balanced price ranges because it's already went through the same area twice, and if a balanced price range becomes inverted, it usually signifies that price is quite choppy if it needs to go through the same range of price 3 times in a row. Now, this doesn't mean that I'll never use an inversion balanced price range, but what I'm saying is that for myself, the narrative of price has to be so blatantly obvious to the point price alone convinces me to use it. Once again, just as any inversion PD array, an inversion balanced price range is created when a candle closes beyond it, invalidating it. And so for example, on the left, if you have a bullish balanced price range, once price closes below it, then it becomes a bearish inversion balanced price range. Vice versa, on the right, if you have a bearish balanced price range, once price closes above it, then it will become a bullish inversion balanced price range. Finally, the last inversion I will be talking about is the inversion RDRB, or the inversion redelivered rebalanced. Just as inversion balanced price ranges, personally, I don't prefer to use them very often. In fact, inversion RDRBs I pretty much only use for one function. And so inversion RDRBs definitely has its time to be used, and I would recommend against using it just anywhere. And that's because in my experience, it just simply hasn't had the greatest probabilities. The only time I would use an inversion RDRB is if it was a part of a true market structure shift. So until you learn what a true market structure shift is, I would just note this down, but not pay too much attention to it for the time being. Once again, just as any inversion PD array, an inversion RDRB is created when a candle closes beyond it, invalidating it. And so, for example, on the left, if you have a bullish RDRB, once price closes below it, then it becomes a bearish inversion RDRB. Vice versa, on the right, if you have a bearish RDRB, once price closes above it, then it becomes a bullish inversion RDRB. That's all for this lecture, and I decided not to include examples of inversion balanced price ranges or inversion RDRBs because once again, it's a very rare occurrence that I refer to them. In my opinion, if you tune into the live streams, it will be significantly more beneficial to understand the context of why I use these types of inversion balanced price ranges rather than just me showing random examples you have no context over. As always, the homework and quiz for this lecture will be posted in the description below. Don't cheat yourself of this learning opportunity. Study and do the work honestly. I promise your hard work will be rewarded. Your assignment for this lecture is to go into your notes or your charts and annotate the PD arrays that were previously taught and extend them out into time. Which PD arrays become inverted? Which inversions are respected? And which inversions are disrespected? See you in the next one, and as always, have a great day.